Welcome back, everybody. Today is the 30th anniversary of Black Monday. 30 years ago today, the stock market crashed as the Dow Jones Industrial Average plunged 22%. Here to talk about Black Monday and tell us whether something like this could happen again is Brent Wilsey, president of Wilsey Asset Management. Brent, always great to see you.
Good to be here as always.
So I got to think 30 years ago, I would guess you were a young investor, and you look at this and you go, wait a second, am I in the right business? Do I really want to go here? What was it like?
It was pretty frightening. I was an accountant for about 3 years. I switched over about 2 years prior to investing. And people don't realize, but in March, we had the bond market crash. Like, oh my gosh, rates are rising, bonds are falling. Then we get hit with this in October. Oh my gosh, am I in the right profession? Because this was scary during that time frame.
So what happened?
What happened was pension funds, a lot of big institutional investors, they knew valuations were high. They wanted some protection. So they came out with this program trading, and it was supposed to protect them. Well, it didn't work, and it just exacerbated even worse, because as things started trading and falling, the psychology kicked in, and it was just a terrible day. It was because of all the psychology of it happening, and the programs didn't work. Program trading did not work.
But now the marketscape, if you will, is different because we have computerized systems now. I think of the old days when you picture the Wall Street, the floor of the stock exchange, and everybody's got the tickers, like at the end of the movie Trading Places.
Yes.
When they're all buy and sell. It's different now.
Yeah, because those are called human specialists, and it was all done by human. They would do that. Now it is all computerized. The difference is now it's more complex. Now you have to question, wait, it's more complex. Is that a good thing or a bad thing?
Sure.
There is no way to stop market psychology. And the thing that we have now, and you and I have talked about before, valuations like 87, once again, are high. And when they're high, eventually things start falling, and it keeps feeding itself is what's going to happen.
So you're saying this could happen again to us?
It definitely can. There's no way to protect it, because if people want out of the market, and now even worse, they have what's called ETFs, exchange-traded funds. About $4 trillion are in these funds. People bought these funds because they want to get out quickly. Well, if they start getting out quickly, it's going to feed itself, and you're going to have a major quick decline.
Well, we look at the stock market now since President Trump took office, and I mean, it's just on a tear. So it's easy to sit back and look at. Then again, investing is counterintuitive. We talked about that too. But it's easy to sit back and go, hey, look, I'm going to ride this horse, man. This is great. Stocks are on the tear.
And you know what's funny is everybody thinks they'll know the day there's going to be a bell rung. Okay, I got to get out. They won't know that. And what's going to happen is a lot of people that bought these high valuation stocks, they're going to get burned again. These ETFs are doing the exact same thing. They think they're safe. I got to warn them. They are not safe. It's going to happen. It could be tomorrow, next week, next year. It's going to happen, because whenever you have valuations that are high, everything comes back to the mean. And 87 will happen again. Maybe not the exact same, but markets do come down.
What can we do to protect ourselves?
Well, what you need to do is you got to stay away from those high valuation stocks. I don't like ETFs because, again, I think they're a false sense of security. The best thing to do is you buy good quality companies that have low valuations, that pay good dividends, and just weather the storm. If you got good quality, yes, they're going to go down, but they're going to come back. So look what you have. Find a good advisor that knows what he's doing, because I hate to say it, in our industry, a lot of great salespeople out there, when the crap hits the fan, I must say the wrong word, they don't know what to do. And that's the problem, is you've got to make sure you've got a good investment advisor that you're working with, as opposed to a salesperson.
Like Wilsey Asset Management, of course.
God, I didn't think of that one. Thank you.
Just helping you out. You said to watch out for low volume stocks.
Yes, low volume stocks, because that's the problem too, is that there's not a lot of volume, trading volume. You want to get out of it, you're going to have to pay a much lower price to get out of it, so you won't get the high thing. So you want high volume, a lot of liquidity. That was another problem in 87, not much liquidity, and when people wanted out, there was nothing there to fulfill it. So you want high volume stocks that, again, a lot of trading activity, so when you want to sell your shares, there's somebody there to take that up, not low volume stocks.
So a fast sell-off, if you look at the market and people are selling and selling and selling, that's a red flag, right?
Yes, yeah, that's definitely a red flag. And you've got to look at a lot of these biopharmaceutical companies that people bought, they're going to be the next cure for cancer. These are low volume stocks because of the fact there's not a lot of people there to get them, and when you try to get out, you're going to be down 20, 30, maybe 40% because nobody wants your shares.
Okay, the website where people can contact you.
Go to smartinvesting2000.com.
Smartinvesting2000.com. Brent Wilsey, always great to see you.
Great to be here.
I learned so much.
Good.
Thanks.